All right, good news for all home loan owners. The Reserve Bank of India has slashed the benchmark repo rate by 1/4%, bringing it to a 5-year low. The rate cut will translate into lower EMIs on home, auto and personal loans for you, but it depends upon how quickly banks pass on this rate cut to you. A huge relief for loan owners. The RBI has slashed the benchmark repo rate by 1/4%, bringing it down by the lowest it has done in 5 years. This will lead to a reduction in your EMIs if you've taken a loan to either buy a house or a car or have taken a personal loan. Of course, how soon the benefit gets passed on to you depends on how soon the banks pass on these benefits to consumers. The announcement being made by RBI Governor Raghuram Rajan. The RBI announcing its policy today, cutting down repo rate by 0.25% to 6.50. Rate cut will lead to lower EMIs on home, auto and personal loans. Reverse repo rate cut by 0.25% to 5.50. We're trying to connect to our reporters, also trying to get some reactions from home loan owners. Of course, all of you who do have to pay an EMI, don't need to be explained what this will mean to you. It's obviously good news for all loan owners. We have market analyst Ashok Ajmera who's with us on the phone line. Mr. Ajmera, good news for loan owners.
No, it's good news, but it was factored in already. Had the repo rate cut would have been 50 basis points, it would have been very positive for the market and the economy on the whole. 25 basis cut was already expected. At the same time, the reverse repo, for the first time, it has happened that the gap between the repo and reverse repo is only 50 basis point, which used to be 100 basis point, which is basically negative. So it's a liquidity bonanza because of the non-maintenance on the weekly basis or daily basis of the CRR of 95%. But overall, it is just on the expected lines. It is not something extraordinary.
Right, and Mr. Ajmera, we're a news channel. Our viewers are also not that clued in to business news. Can you simplify the jargon for us a little bit and explain to us how this will translate for people who have loans?
No, it means that the repo rate coming down by 25 basis point. It means the interest rate comes down by 25 basis point. But in effect, it is not so because the banks have to balance their rate of interest which they pay on the fixed deposit, which just doesn't change overnight or in a day or a week or a month. So they do not pass on the entire benefit to the customers in the lending rate because they have to match the difference, their net interest margin.
All right.
And with the marginal cost coming in any case it has been factored in. So it's for a normal viewer, he should understand that the interest rate regime is, this overall psychology and the direction is that the interest rates are coming down. Reserve Bank of India says that I have brought down the interest rate by 0.5%.
All right, Mr. Ajmera, thank you so much for breaking this down and simplifying this for us, making us understand what it really means for people who have taken loans from banks. We also have Mr. Alok Churiwala, who's a market analyst. He's with us on the phone line. Mr. Churiwala, what do you make of this announcement?
Well, the markets were hoping against hope for a 50 basis point rate cut, but unfortunately, sanity, shall we say, of wider market expectation has prevailed, and only a 25 basis point rate cut, which one can say is largely.
All right, we seem to be facing some trouble on that line with Mr. Alok Churiwala. We'll try and reconnect with him. The big story we're tracking, the Reserve Bank of India has slashed benchmark repo rate by 1/4%, bringing it down to a 5-year low. The rate cut will translate into lower EMIs on your home, auto and personal loans. Of course, it all depends on how soon banks pass on the benefits to consumers. Market analysts who we've been speaking to claim that this 0.25% rate cut was on expected lines. They'd actually been hoping for a higher rate cut of 0.5%. That, of course, didn't happen. The RBI slashing the benchmark repo rate by 1/4%. Right, back to our top focus at 11. Major relief for everyone who has a loan. The Reserve Bank of India has slashed the benchmark repo rate by 1/4%, bringing it to a 5-year low. Rate cut will translate into lower EMIs on home, auto and personal loans, but it depends upon how quickly banks pass on the benefit.
The quantum of rate cuts is passed through into borrowing rates. The introduction of the marginal cost lending rate, the MCLR, since April 1st will help. Our first estimate from the 26 largest banks in the system, accounting for about 83% of activity, has been that since the last week of March, the median overnight MCLR is down by 50 basis points from the base rate and is down by 25 basis points across all tenures. This is important because it means an actual rate cut to the borrower of a further 25 to 50 basis points at least, even before today's rate cut. Put differently, policy action is significantly greater today than just another 25 basis point cut. Borrowing is now significantly cheaper and will continue to get so. To further this process, a major focus of this policy has been to address liquidity issues. After a detailed review and internal discussions, we've brought in significant refinements to our framework, including clearer differentiation between the durable liquidity needs of the system and short-term liquidity needs, indicated an intent to move closer to neutral on overall durable liquidity needs, reduced the MSF rate by 75 basis points, and increase the rate at which banks can deposit at the RBI by 25 basis points so as to narrow the interest rate corridor, reduce the minimum daily maintenance of CRR to 90%. All these measures, along with the government's actions on small savings rates, should also help continue the process of transmission. In addition to further durable liquidity provision, we have announced an open market operation, a purchase of government securities of 15,000 crores today. The monetary policy stance remains accommodative. Going forward, we will be looking for further monetary room in signs of good monsoon, further readings of low headline inflation, indications of softening in core inflation, and further evidence of transmission of rate cuts. Part B of this policy statement also has a number of reform measures, including continuing opening up of the banking sector, new market instruments such as money market futures, broadening participation in and easing access to markets, such as allowing retail customers the ability to trade GSECs and to undertake foreign exchange trades, and strengthening financial inclusion through measures such as improving the business correspondent network. Moreover, in the weeks to come, you will see a fulfillment of our past announcements, including the release of guidelines for on-tap licensing of universal banks, the start of the trading platform for priority sector lending certificates, and the introduction of mobile-to-mobile transfers through the Universal Payment Interface by NPCL. Finally, the process of cleaning up bank balance sheets is well underway, and I'm happy with the progress made thus far. My colleagues and I will now take questions.
Yeah, there is a mic. Please announce the name, organization, and question.
This is Supriya Srinath from ET Now. Great to be here at your turf. But I must ask you the first question on liquidity boosting measures. A lot of people believe that you are moving beyond interest rates to do your bit for boosting growth. And there is a change in stance from the RBI. The RBI has always, in its own wisdom, believed there should be a liquidity deficit. You're talking about that being reduced to zero. Is this a conscious effort to change the stance that has been over all these years? And how worried are you about the pay panel recommendations? Because you're talking about 100 to 150 basis points impact eventually when that does roll in.
Yeah. On the first issue, which is the liquidity measures, a lot of our activity on the monetary policy front is driven by the Urjit Patel Committee report, which laid out both a change in the monetary framework as well as a change in how we deal with liquidity. Now, given the various measures that have been taken to fix the policy rate at close to the repo rate through these overnight instruments, the need to maintain the system in liquidity deficit no longer is there. Therefore, on a review of how far we had come with these overnight instruments, we decided that it was no longer necessary to maintain that significant liquidity deficit. We could move towards a more neutral position, which is what was announced today. On the issue of the 150 basis points in the that it was no longer necessary to maintain that significant liquidity deficit, we could move towards a more neutral position, which is what was announced today. On
and an estimate and a mechanical exercise, essentially on account of the adjustments in the HRA that will take place eventually at both the central government level and at the state government level. We will refine those projections as more details emerge. The thing to notice is that most likely the impact of the 7th Pay Commission on the headline inflation will be considerably less than in the previous Pay Commission, and I think even from the 5th Pay Commission, because there are going to be no arrears, and therefore the overall impact would be most likely much less than on account of the previous Pay Commissions. But that number is essentially on account of changes in housing HRA, and given the weight of housing in the CPI combined, it's noteworthy that in previous editions the impact was felt on the CPI industrial workers, where the weight of housing was larger. It was 15.3%, and now it's about 10%. So that's the background to that projection, which may undergo change as we get more information on both the rollout and the timing. Thank you.
Morning, Governor. Lata Venkatesh from CNBC TV 18. Now you put on your Santa Claus hat for liquidity. How quickly do you expect the system to get into balance or near neutrality? Also, when you say near neutrality, would it be habitually a minor deficit, or would it be minor deficit, minor surplus? Therefore, would you be okay if call rate on certain days is below the repo rate? What would be the habitual behavior of the RBI? What is the corridor it will move in? Right. If I can add the inflation question as well, as my colleague asked you, this 150 basis points is not factored into your 5% inflation on Jan 17th. Is it factored into the MPR's 4.2% inflation in January 18? It is not. So if it is factored in, we are looking at a very different number. Then what happens to your word accommodation? How much of the 150 could be durable? Is there any estimate?
Yeah. First, on your question on liquidity, the truth is that the durable liquidity status of the economy will not affect how close the day-to-day call money rate is to the policy rate. That is determined by our short-term measures. That will continue to be determined by our short-term measures, and we hope to hug the policy rate as far as possible, with the call money rate to hug the policy rate. Whether we go into a little bit of surplus, little bit of deficit, I think that now is actually immaterial. The point is that we're moving towards that. The period over which we move depends to some extent on market conditions, depends on the flows that that come in. Remember, net foreign assets is part of the liquidity move. So we have to work it out. We have to see how this move takes place. All it means an additional, moving from a 1% deficit to about neutral, means an additional removal of deficit by about 80 to 90,000 crores. So we have to see how much the system can take. That is something we have to figure out. That's precisely what...
I'll tell you why. Because it has not been at 90,000 crore. Your deficit has been 1.5 lakh, 2.5 lakh crore. You may argue it's not enduring or durable. Yeah. But the reality is, for the banks, it has been 2.5 lakh
there
crore.
Are a couple of new, shall we say, sources of deficit that we have to look at and see how permanent they are. One is government balances have increased on average over the year. And second is most recently cash with the public has increased quite a bit. We have to figure out. It's about 50,000 crores in excess, 50 to 60,000 crores in excess from what we were estimating. We have to see how this plays out. So it would be, I think, premature to give you a sense of how long it will take us. Again, I mean, we're not talking quarters. We're talking a year or two. The question is whether it's a year or whether it's 2 years, by which time we get into neutrality. The 150 basis points again. You want another crack at it, or shall I take it?
No, that's. No, it's correct that neither the March 17 number nor the March 18 number, and the MPR makes it very clear, does not include the impact of the pay commission. To what extent this is durable, we have given an estimate of the indirect effects, which are about 40 basis points. What is mechanical and just an index adjustment, most likely we would look through. What is impermanent and causes externality for the rest of the CPI, we will have to imbibe that in our projections. We have not done that exercise yet, in part because there is a fair bit of uncertainty on how this is going to evolve.
In breaking news coming in, the centre is to withdraw its appeal from the Supreme Court against the 2006 Allahabad High Court verdict, holding the Aligarh Muslim University as a non-minority institution.
Footwork correct? Hi, this is Kohli very big. Maintain this, huh? Hi, this is Kohli very